All right. Welcome to a championship battle between two consumer staple giants, General Mills and J.M Smucker. By the end of this video, we will find out who is the true winner between the two. But let's back up here for a moment because what we're seeing in the economy is an interesting phenomenon. We have inflation that is now morphing into stagflation, and soon enough it will become a recession. You see, inflation has different phases. It has the honeymoon phase in the beginning, where employers are getting paid more. We see wage inflation moving higher, stimmies all over the place, the consumer is buying goods, services, upgrading their homes, their cars, etc., etc. Likewise, businesses in the honeymoon phase of inflation can increase prices and get away with it, and therefore we see corporate profits and corporate margins increasing dramatically. That is the honeymoon phase of inflation. Everything's hunky-dory, but then comes the dark side of inflation, the ugly side, when inflation becomes too much, when prices rise too fast by too much, and it becomes burdensome on the consumer because their wages are not catching up with the rise in prices around them. Likewise, corporations' ability to increase prices and get away with it without damaging demand becomes really diminished. Once an economy hits that phase, it enters stagflation. We're seeing this happening in different sectors of this economy. We don't have stagflation in the entirety of the economy yet, but we're seeing stagflation in many different corners of this economy, such as retail, for example. Demand is going down because the consumer is distracted now. They have to spend more in essentials, in gas, utilities, rents, the grocery store. They cannot afford to spend more money in retail businesses buying goods. As a result, we're seeing a lot of retail stores not being able to maintain their pricing power. They have to cut prices down because they're seeing demand waning down. And therefore, they're seeing their profits or margins getting destroyed. Mind you, they paid top dollar for the supply that they have right now, the inventory. But all of a sudden, the demand is not here, so they have to eat a loss in that inventory. And therefore, we see stagflation in the economy, little by little by little, sector by sector by sector. And then the Federal Reserve realizes that inflation is not going down, it is lingering. Maybe it goes down from 8.5% to 6.5%. This is, of course, according to the CPI, which nobody trusts anyways. We all know that inflation is at double digits right now. But hypothetically speaking, even if inflation goes down to 5.5%, it is still well above the 2.5% target by the Fed. What does that mean? Once the Fed realizes that the economy is in stagflation and inflation is not going away, well, they have to act. And by acting, we mean tightening the monetary policy, increasing interest rates dramatically, which causes the economy to dip into a recession. This is how the cycle works. And if this was a little too complicated for you to understand, here's the greatest of all time, Dr. Milton Friedman, explaining all of that to you, perhaps in a better way. Take a listen.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first and the good effects only come later. That's why it's so hard to persist with the cure.
Now, in both the honeymoon and the ugly phases of inflation, certain businesses tend to thrive. Certain businesses tend to hold a lot better than the others, specifically during the dark phase of inflation, after the honeymoon period already passed. And these businesses tend to be essentials when it comes to consumer spending. We're talking about rents, we're talking about gas stations, spending at the pump. But that's also cyclical. When we see job losses, you're not going to see much spending at the pump. We also have the consumer spending on utilities. You got to pay your bills, your power bills, your water bills. All of that has to be paid, and therefore we see utilities companies faring a lot better during both the honeymoon period of inflation and the ugly phase of inflation. Likewise, another essential item that the consumer has to spend on, and they have no other alternative, is spending at the grocery store. And therefore, we see consumer staples holding a lot better in inflationary periods, but specifically during the ugly phase of inflation. Why? Because consumer staples, specifically those who are related to food, happen to be essentials. The consumer cannot really forego food. They can cut down in their spending on goods, on traveling, on services, etc. But they cannot really cut down spending on food. They can try, they can trim their spending here and there, yet at the end of the day, they have to pay to eat, and therefore we see consumer staples holding a lot better in both periods of inflation, specifically in the ugly period of inflation. In this case, consumer staples related to food. Why? Because in the ugly period of inflation, the consumer has to cut down. One of the first things that the consumer cuts down on is dining outside. It is a lot cheaper to cook at home, and therefore we see these consumer brands thriving under the ugly stage of inflation. Look, for example, at the performance of the XLP, the ETF for consumer staples, in light blue, versus the performance of the Qs, the NASDAQ in red, the SPY, the S&P 500 in white, and the IWM, the Russell 2000 in red. This is the performance since 2021, all the way till today. As you can see, yes, the XLP was lagging under the honeymoon phase of inflation, but it maintained its advantage when the economy finally hit the ugly stage of inflation. Net, since 2021, the XLP is still positive at gains of about 8.5%. The S&P 500 is positive at around 2%, yet lagging the XLP. And of course, the S&P is positive since 2021 because of the outperformance of energy. Absent of that, the performance of the SPY would have been closer to the Qs, the NASDAQ, which is down about 10% since the beginning of 2021. Likewise, the Russell 2000, the IWM, is down about 12.5% since the beginning of 2021. And even year to date for 2022, as you can see, the SPY is down over 20%, the IWM is down over 23%, and the NASDAQ is down a stunning almost 30% year to date. Yet the XLP consumer staples, be it negative, down at about 5%, it still managed to outperform all of them. The S&P 500, the NASDAQ, and the Russell. Why? Because these businesses under consumer staples happen to outperform and maintain their pricing advantage under the ugly stage of inflation. But there is a problem, and this problem is when you lump the good, the bad, the ugly under one ETF, that tends to distort performances and lump good stocks with bad stocks, and hence we see the XLP down for the year. But if it wasn't for the lumping of the good, bad, and ugly, if the consumer staples ETF indeed represented consumer staples and was not lumped in with stores such as Walmart and Target retail stores, the XLP would have been positive year to date. But let's hold that thought and go back in time a few weeks ago when I covered the chart of GIS, General Mills, and SGM, J.M Smucker. Take a look. GIS, General Mills, it is on a positive trend. This is a weekly chart, and it's now facing the resistance from 2016 at around 73. If the name breaks above 73, likelihood is we will see a pullback to 73. That would be a rebound and then a move higher again. So keep an eye on this chart. Another one is the ticker SJM for Smucker. This is a monthly chart. Again, a defensive name, a food-related name. We're seeing the saucer formation, which should get us all the way to the previous highs at around 154.5. That would be a gain of about 6.5% from this point on. And here's the update. Unfortunately, both charts went down since I covered them last time. GIS went down all the way, and this is a weekly chart, by the way. It went down all the way to retouch the trend line, and then it bounced higher, big time, and it managed to cross above 73, which was resistance before. Different story for the chart of SGM. J.M Smucker, this is a monthly chart. Instead of moving higher to retouch the prior resistance, the prior all-time highs at around 154.5, the chart went down big, and now it's working its way higher again. So the question is, will we see SGM playing catch-up such as we saw with GIS? And soon enough, we will see this chart reading at above 154.5. If that is the case, then this presents us with a trading opportunity to buy right now, or at least buy call options on SGM. But before you do that, we have to understand why these charts went down to begin with. The answer is, remember this from Walmart a few weeks ago?
Okay, so kind of a mixed quarter here with Walmart's first quarter. A large miss for profit, much larger than we normally see. The retailer reporting $1.30 adjusted compared to an expected $1.48 per share, but on stronger sales of $141.57 billion. Estimates were looking for $138.94 billion. And Walmart doesn't typically adjust guidance at this point in the year. It is doing it here, increasing its sales and lowering profit expectations for the year.
So Walmart's earnings came out disappointing a few weeks ago. They still maintain that sales will continue to move higher, Sales will be positive in growth year over year, but different story for profitability. What does that say? Walmart's ability to continue to raise prices with no consequences is now diminished, and therefore we saw Walmart crashing right after earnings. On top of that, shortly after Walmart's earnings, we got bad news from another giant retailer, Target. And viewers of this channel remember the Target CEO was live on CNBC sweating bullets right after earnings as his stock was crashing. Take a look.
I frame it by really looking at kind of the front of the house of our business and then the back of the house. And if I think about the front of the house, the consumer guest facing component, we saw really strong comps, over 3% on top of 23% last year. And importantly, it was driven by traffic. Traffic up 4% on top of 17% last year. Guests are shopping our stores. They're enjoying our services. They're using Drive Up. But clearly, the challenge for us in this quarter was the back of house. From a freight and transportation standpoint, things have changed significantly from even 13 weeks ago. I did not project the kind of significant increases we would see in freight and transportation costs. And you've been talking about it on CNBC almost every day. I think yet again this morning you talked about all-time record fuel and diesel costs. Right now we project that's going to hit us about $1 billion of incremental costs in this fiscal year.
So we go back to the same problem. Why did the charts of GIS, General Mills, and SGM, J.M Smucker, go down? The answer lies in the ETFization of the stock market, which I'm not a fan of. You see, the ETF, the XLP, includes Walmart and Target. These are giant components of the ETF. When these names get sold off, due to bad earnings, the ETF dumps the good, the bad, and the ugly. In this case, it dumped consumer brands, including GIS, SGM, Hershey's, Kellogg's. All of them went down. Some would argue that that was not justified. Walmart, Target, these are different businesses. These are retail businesses, not consumer staple brands, which tend to have a stickier pricing power. But again, we saw the good side of ETFization of the stock market in the last, let's say, decade or so, when the good, the bad, the ugly all rise together because funds are buying the ETFs. Now we're about to see the ugly side of ETFization of the stock market, which when one stock gets dumped, and this stock happens to have a huge weighting on the ETFs, everything goes down with it. And that is the ugly side of ETFs. Now, the fact that a chart like General Mills, GIS, not only managed to recover, but to make all-time highs, what does that say? It indeed reaffirms that General Mills is a different business than Walmart and Target. And the hit to that stock was not justified. Matter of fact, it was a buy-the-dip opportunity, because this stock shouldn't have gone down to begin with. Now, when I covered these charts initially, I also covered charts such as McCormick, Kraft Heinz, and consumer staples. What we're now finding out is the fact that McCormick, another giant consumer brand, is losing the battle to inflation. They can no longer increase prices and get away with it. And therefore, in the last earnings report for the company, we saw margins getting crushed. We saw the outlook being absolutely abysmal, and the stock went down further, even after getting hit with the Walmart/Target crash. Likewise, another stock like Kraft Heinz did not recover for a different reason. And that reason is, as inflation continues to move higher, the consumer is opting to alternative brands, to store brands. So instead of buying Kraft Heinz cheese slices, they're buying the store's brand, be it Walmart, be it Kroger, doesn't matter, because it is cheaper. This is the impact that inflation has on consumer behavior and consumer spending. The question that we have right now for these two companies that I'm covering in this video, General Mills and J.M Smucker, do they have the same problem as Kraft Heinz, where the consumer is going to opt to buy store brands? In my opinion, no. I mean, if you're going to serve me Cheerios, you better serve me actual Cheerios. I'm not going to eat any of that Chinese crap that gives you cancer, even if it is cheaper. And this is why I work so hard, so I can afford actual Cheerios. Likewise, when it comes to J.M Smucker, think about it like this. If you have kids and you make grilled cheese sandwiches for them, for example, and you switch the slice of cheese from Kraft to the store brand because it is cheaper, will your kids notice the difference? Chances are not really. But if you switch their Cheerios to the cheap Chinese Cheerio with the cancer thing, are they going to spot the difference? Chances are yes, they will. Likewise, if you switch the peanut butter and jelly sandwiches from Smucker to the other cheap crap that tastes like vomit, you think your kids are not going to notice the difference? Think again. And therefore, these two businesses, General Mills and J.M Smucker, are one of the top picks in consumer staples right now. But at the end of the day, only one can be a winner in this battle, the heavyweight championship battle in consumer staples, with the reigning, undefeated heavyweight championship of the world, General Mills, versus they're trying to make a splash here, J.M Smucker. But don't count them out yet, because there could be a surprise knockout punch in this battle. So without further ado,
let's get it on!
and I'm going to start with this template right here to score this fight. We're going to look at the technical analysis, the revenue growth year over year, the net income growth year over year, the operating margin, the currency impact on both companies, the price to sales ratio, the price to earnings ratio, and lastly, the historical performance under a recession for both companies. Let's start with this. When we looked at the chart of General Mills, GIS, I give this chart 5 out of 5 stars. And the reason is, despite the heavy hit that the chart got after Walmart and Target, it managed not only to recover, but to make all-time highs. This is a strong chart, perhaps one of the strongest we have in the market right now, and therefore, GIS gets 5 out of 5 stars. Now, let's look at the recent earnings report for the company. Here it is, the income statement. Net sales went higher year over year by about 8%. Likewise, the cost of sales went higher by 6%. Now, you have a dynamic in a company where sales are growing higher by 8% year over year, while the cost of sales growing higher by 6%. This is a good dynamic for the company because the growth rate in sales is faster and larger than the growth rate in the cost of sales. Likewise, the expenses for the company actually went down by 2% year over year. What does that say? The company has good management, they're being more efficient under this inflation, and therefore the operating profit was up by a stunning 85% year over year. But bear in mind, the last year General Mills incurred certain charges because I believe they acquired the pet food business from Tyson. So the base effects will distort the operating profit and net earnings. With that being said, for now, the operating margin, why do we use this ratio to begin with? The answer is, when you divide operating profits with net sales, what you get is how much does the company keep in profits for every dollar generated as revenue. If the company makes $1, how much of that $1 the company keeps in profits after expenses, after paying for the goods, etc., etc. In this case, the operating margin for GIS is 21. That is a decent margin. It means that out of every dollar the company generates in revenue, they're keeping 21 cents. And therefore, the net earnings for the company went higher by a stunning 97% year over year. Now, bear in mind, once again, the base effects are amplifying the growth rate in net income, because last year General Mills incurred certain charges. But even with that, even if we subtract the base impacts, net earnings went higher by a stunning 31% year over year. Here it is in the scoreboard. The revenue growth year over year, 8%. The net income growth year over year is 97%, with a footnote that absent of base impacts, the growth year over year net income would have been 31%, and the operating margin is 21%. Let's continue with the earnings from GIS. For the different segments that they have in the business, net sales for North America retail went higher by 11%, while net sales for international segment went down by 21%. Pay attention to this. This will be important. Sales are down 21% year over year in the international segment. For the pet segment, net sales went higher by a stunning 37%. And in North America food services segment, the sales for that went higher by 25% year over year. But what really counts under this inflation is the operating profit. Sales could be down year over year, but if the company has the pricing power, you will see operating profits moving higher despite the fact that net sales could be down year over year for the particular company we're looking at. In this case, the operating profit for North America retail was up by 18% year over year. Likewise, for the international segment, while net sales were down 21%, look at this, the operating profit was higher year over year by 36%. What does that say? Yes, sales were down. The demand was down. The volume of sales was down. But the pricing power of the company made up for that and then some. Likewise, in the pet segment, the operating profit was up by 10%, while in North America food service segment, the operating profit was higher by 23% year over year. All in all, the operating profit for General Mills went higher by 18% year over year. These are decent numbers. You're not going to see these kind of numbers at any other company, besides perhaps certain utilities, certain consumer defensive staples, but that's about it. Here's another illustration for you about the pricing power of this company. We look at the different segments of the company for the fourth quarter, year over year. The growth in volume was down by 3 points in the North America retail segment, but it was positive by 12 points in the pet segment, yet it was down again by 2 points in the North America food service segment. And lastly, in the international segment, the volume was down by a stunning 33 points. All in all, with exception of the pet segment, this company is selling less volume year over year. Now, you might say that this is bad, but here comes the pricing power. When we look at the price mix, that contributed 15 points to the North America retail segment. Likewise, it contributed 25 points to the pet segment and 27 points to the North America food service segment, and lastly, 14 points to the international segment. So the company's pricing power is covering for the fact that they're selling less in volume. Likewise, when we look at the foreign exchange impact, the dollar is moving higher, and therefore for the international segment, the currency impact shaved off 2 points of the reported net sales for that particular segment. Now, to further illustrate the negative impact of the rise in the US dollar on the international segment of General Mills, here it is. When we look at the operating profit growth, it is reported to be 36% in the international segment, as we covered before. But absent of the rise in the US dollar, that operating profit for the international segment for General Mills would have been a stunning 40% year over year. So again, to wrap it up, the currency impact had a negative impact of 1 point. All in all, not just for the international segment, but for the company entirely. And therefore, that would be a -1 in the currency impact. And here's a visual illustration for you, perhaps better than the tables, to break down exactly what contributed to the increase of sales for the company by 8% year over year. As you can see, the only positive contributor is the organic price mix, meaning the pricing power, which contributed to about 14 percentage points. But the volume of sales was down by 2 percentage points. Likewise, the foreign exchange impact was down 1 percentage point, as we explained before. And lastly, acquisition and divestitures contributed to a negative 4 percentage points. All in all, net sales went higher by 8 percentage points. But again, absent of the pricing power, this could have been an ugly report, so keep that in mind. And here it is, lastly, in the gross margin, just to illustrate for you again the importance of the pricing power. Gross margins actually went down from 34.8% last year to 33% this year. And the negative contributors are inflation, big time, and then we have supply chain disruptions. On the other hand, the positive contributors, be it the pricing power and HMM, this is an efficiency program for the company, General Mills, and as you can see, it is working out perfectly. Now, the company says for its 2023 forecast, net sales will grow by 4 to 5%. Now, this is a decent growth rate, but we'll take it with a grain of salt because nobody can really estimate what's going to happen, specifically as this economy dips into a recession. So we'll take that with a grain of salt, but keep in mind that the projection for now is 4 to 5% growth. And lastly, let's do the valuation metrics for the company. The price to sales ratio is 2.43. That means you're paying 2.4 times what the company generated in sales last year. Likewise, the PE ratio is 17.7. This is not a good ratio because you're paying 17 times what the company generated in earnings last year. We're not going to use the forward PE, and the reason is all of these earnings estimates have to come down. They're too inflated for now, and they're going to distort all of these valuation metrics. So we'll leave that at for now. Let's move on to SGM, J.M Smuckers, and see how that fares against General Mills. Here's the income sheet from the last report. As you can see, net sales went higher year over year by 6%. On the other hand, the cost of goods sold went higher by 15%. So this is the opposite dynamic that we saw in General Mills. For that company, the growth rate in net sales is exceeding the growth rate in the cost of goods sold. Here, we're seeing the opposite story, which is a bad dynamic, and therefore the gross margin is actually down 9 points year over year. But the good news is, if you thought General Mills' efficiency was impressive, take a look at this. Expenses for this company, SGM, J.M Smucker, went down by 14% year over year. And therefore, the operating income was positive, and the operating margin was at 14.8%. Likewise, the net income growth was positive by a stunning 37% year over year. Put it all together in the sheet. The technical analysis for SGM's chart, I will give that 4 out of 5 stars. It is certainly performing a lot better than many charts in the stock market right now. Not as impressive as GIS, but good enough, very close to all-time highs, and therefore we'll give it 4 stars out of 5. The revenue year over year for the company went higher by 6%, while the net income went higher by 37%, and the operating margin stands at 14.8%. Let's continue with earnings. For the different segments for the company, pet food net sales went higher by 6% year over year. Coffee went higher by 11% year over year. And the disappointment came from consumer food, which went down 5% year over year in sales. And lastly, for the international segment, sales went higher by 12% year over year. But again, what really matters is the profit margin under this inflationary status. Well, the profit margin for pet food went higher by 16.8% year over year, and it was positive, so this is good. For coffee, the profit margin is an impressive 25.4%, but bear in mind, this is down 440 basis points from last year. For the consumer food segment, while net sales were down 5% year over year, the profit margin was positive by 23.9% year over year, and it was positive from a basis points perspective year over year. What does that say? Maybe the company is selling less, but the pricing power is still intact, and it is making up for the loss in volume and then some. Lastly, for the international segment, the profit margin was up by 12.7%, and it was also positive from a year-to-year perspective. To shed more light, here is the sheet. And as you can see at the bottom, the profit margin for pet food went higher from last year's 15.1% to 16.8%. For coffee, while the profit margin is an impressive 25.4%, it was actually down from the even more impressive profit margin of last year of 29.8%. For the retail consumer food segment, the profit margin growth rate went higher from 22.6% last year to 23.9% this year. And lastly, for the international segment, the profit margin went higher from last year's 12% to 12.7% this year. All in all, this is an impressive report. This is a company that is still beating inflation, at least for now. We will look at the consolidated results. What really contributed for the growth in net sales year over year for J.M Smucker? It certainly was not the volume of sales. That went down by 1%. It certainly was not the foreign exchange impact. That was pretty much neutral. It wasn't divestitures. That was down 3%, perhaps related to Russia. It was once again the pricing power, the net price realization that went higher by 10%, and therefore we have a positive growth rate in net sales year over year. Absent of the pricing power, once again, this could have been an ugly report. So here it is to wrap it up. In the board, the currency impact was neutral, 0, and the valuation metrics for the price to sales ratio is 1.73. You're paying $1.73 for every dollar that the company generated in sales last year. Likewise, the price to earnings ratio is 21.95, which means for every dollar the company generated in earnings, profits, you're paying $21.95. But bear in mind, this is a lagging indicator from last year, and if it is updated to the current results, it will get a little cheaper. But we're using these metrics as for now to distinguish between two companies. And lastly, before we move on and reveal the winner, the 2023 outlook for J.M Smucker, the net sales are expected to grow by 3.5% to 4.5%, slightly lower than GIS, but again, we'll take this with a grain of salt because nobody can really expect what's going to happen as the economy dips into a recession. So here it is, the moment of truth. But before we do that, what about the recession performance for both companies? We can do that by looking back at the last recession that we got in 2009. And what I want to look at is how long did it take for the company to recover the prior highs after dipping into a recession, after the crash of 2008-2009? Well, for General Mills, GIS, it took about 469 days before reaching the same highs before the crash. For SGM, J.M Smucker, it took about 1,225 days before reaching the prior highs once again. But this is not fair because J.M Smucker had a spike, shoot up higher, spike top before the crash. Now, if we factor that out from the equation, relatively took the same amount of days, the same length of time for SGM to recover its prior highs. So maybe this is not the fairest way to determine who's the winner here. Another way we can look at it, look at the performance from 2008 all the way till 2010. GIS in blue, SGM in red, and then we have the SPY, the S&P 500 in yellow or orange, whatever that is. If you bought GIS or SGM in the beginning of 2008, by the end of 2009, you were up about 25% in both GIS and SGM, despite the crash, despite the recession, despite the yada, yada, yada. On the other hand, had you bought the SPY, the S&P 500 in 2008, specifically the beginning of 2008, by the end of 2009, you were still down by 21.5%. So which one is a better deal? Which kind of stocks perform better even during a recession? The answer is consumer staples. They maintain the pricing advantage all the way till the end of inflation, and then they maintain the advantage in consumer spending even during a recession. Why? Because they happen to be necessities. They happen to be essentials in consumer spending. Another way we can look at it, look at the contrast of performance between the two stocks since the bottom of 2009 all the way till today. SGM, J.M Smucker, is up by about 250%. On the other hand, GIS is up by about 189%. So we have a winner here from this perspective alone in SGM. Another way we can look at it, at least from the year-to-date perspective, for 2022, GIS is up by about 12.5% year-to-date. On the other hand, SGM is down by about 3.5%. So, in the short run, if we have a catch-up trade, SGM could be the better pick here. But in the long run, when you look at the recession performance for both during 2008, 2009, I would say that GIS, General Mills, has the advantage, be it a slight advantage. So here we are, the moment of truth, the scoring board. When it comes to the technicals, who is the winner here? The answer is clear. General Mills, GIS. It's a better looking chart, no doubt about it. When it comes to the revenue growth year over year, the winner is clear once again, GIS, with 8% growth in revenues year over year versus the 6% from J.M Smucker. When it comes to the net income growth year over year, mind you, 97% for GIS, but to be fair, when we take out the overcharges from last year, the net income growth year over year is 31% versus SGM's 37%. So in this case, I'm giving the win for SGM. What about the operating margin? You can argue once again that the base impacts are inflating the operating margin of GIS, but looking at all of these results, it is clear which company is more efficient. In this case, it is GIS with an operating margin of 21 versus an operating margin for SGM of 14.8, and therefore the winner is, once again, GIS. When it comes to the currency impact, it is really negligible because it is down 1% for GIS and neutral for SGM, but I'll give the winning points for SGM here. When it comes to the price to sales ratio, which one is the cheapest stock? Clearly, from that perspective alone, it is SGM with 1.73 versus 2.43 for GIS. When it comes to the price to earnings ratio, once again, GIS is a better deal than SGM with 17.07 ratio when it comes to price to earnings versus the 21.95 for J.M Smucker. And lastly, when it comes to the recession performance, it is up for debate. I presented all of the arguments, different ways we can look at it, but the consistent theme, in my opinion, is GIS tends to perform better, at least in the initial stages of the recovery from a recession crash, than SGM. Maybe in the long run, J.M Smucker presents more growth opportunities than General Mills, but in the meantime, when we talk about a recession performance, I am awarding the points to GIS. And here it is, all in all, the scoreboard. General Mills for the win, 5-3. And folks, this brings us to the end of this battle with a clear winner, GIS, General Mills. But the debate on who is the king of consumer staples continues to go on. If you'd like to see more battles like this one, let me know in the comments, and we can finally find out. We can do another one between GIS and Hershey's. We can do another one between General Mills and Procter & Gamble, for example, to find out who's the true king of consumer staples, because there is only one. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. Happy 4th of July. Happy birthday, America. Enjoy the festivities. And I'm going to talk to you again tomorrow.